And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. It is, of course, the second best day of the week, and thank goodness this week's almost over. It's been a tough week for the markets. A couple of things to get into. Michael Leibowitz joining me this morning. We're going to talk a little bit about the inflation data yesterday. Inflation did come in hotter than expected, but has it peaked? That's going to be the real question here. And interestingly enough, bond yields may be giving us a clue in that direction as well. And so we'll kind of get into that conversation this morning, kind of what comes next. But stocks continue to be under a lot of pressure yesterday. Stocks were trying to open higher yesterday morning after, being oversold here for the last few days. And we had talked about yesterday morning that after having a very deep oversold, due for a bounce, markets were opening up yesterday. Then, of course, as we were getting ready to open higher for the morning, the inflation print came out, coming in a bit hotter than expected, and that led to basically a sell-off in stocks. Again, concerns over inflation and what's happening, really kind of impacting a lot of the NASDAQ stocks. We're seeing, a lot of selling pressure in, higher beta stocks now that we're kind of getting later into the sell-off. And one thing we had talked about, early this year is that the indexes were masking what was going on below the surface of the indexes, right? A lot of these companies are down 40, 50, 60, 70% or more in a lot of cases, but the indexes were really holding up pretty well. The S&P is down about 18% for the year now, compared to a lot of these stocks are down a lot more. And the reason for that is that because the selling hasn't been in the big mega cap names until lately. And just over the last really week or so, Apple, Microsoft, Google have come under a lot of pressure here, and that's now starting to really weigh, in April, and then here so far in May has really kind of been weighing on the index because now the generals are getting sold off. And there's two things that are kind of interesting about this. One, margin debt has reversed fairly sharply here over the last couple of months, and part of this sell-off in the bigger cap companies. Also, we saw the other day big sell-offs in energy names. In particular, which has been the go-to trade this year. We saw ExxonMobil and Marathon and others down 8, 9, 10, 11% in a day. And what that suggests is that you're getting some margin calls coming in. And a lot of these young retail traders, et cetera, that were way out on margin are now having to sell their good stocks to cover the margin calls. And that's part of that margin call process when if you had a bunch of the ARC type companies that are down 60, 70, 80%, you're going to get that phone call that says, hey, you need to cover your exposure. And if all you've got left is your Apple and your Microsoft, eventually that has to get sold. And that may be part of what we're seeing here is that kind of that capitulatory selling here. And there's also just that side of it too. This market has been brutal this year emotionally. And look, the market's down 18%. And it sounds terrible, right? It's like 18%. Sounds terrible. Remember, up 26% last year. So you're giving back those gains. But again, this has been a fairly orderly decline. There's not any kind of moments in here, really, even going back to the beginning of this year, where you just have this market just kind of falling apart every day, like we saw in March of 2020. This has been a fairly orderly decline here. And I know that's not very comforting for you, and I'm not trying to make light of the situation because it is troubling here where we are financially this year so far. And markets, again, we're halfway through the year. Markets are under a lot of pressure. Things don't really, seem to be kind of holding supports where they should be. But again, this has been an orderly decline. We're not seeing a tremendous amount of panic. We're not seeing a tremendous amount of just, investors just kind of giving up the ship yet, which is part of a problem as well, because generally we are not going to find long-lasting bottoms. We're going to find the bottom until eventually investors go, screw it, I'm out, right? I'm done. I don't want nothing else to do with this market. We're not seeing that just yet. However, as we've been saying here over the last few days, all of our indicators are at levels now that suggest that a tradable bounce is likely. And again, we haven't gotten it yet. And that's very frustrating by every stretch of the imagination. But we're kind of in this very heavy 3 standard deviation territory, normally where you see a bit of a reflexive bounce. Where's that going to get you to on spiders, the S&P 500 ETF? Currently about 420, 421 on that ETF, on the index, around 4,200. Very, very possible there. Again, not a huge move from where we are now, but certainly a better level to sell at than where we are right now. And again, these kind of reflexive rallies back to the 20-day moving average, very common here, and we've been seeing that consistently even from this peak decline that we had starting back in March. We've had these kind of continual retests of the 20-day moving average. So a bounce back to the 20-day moving average, good first level to start reducing risk, adding some hedges to portfolios, etc. One thing I said, though, is that bonds in particular are also kind of helping us out here lately. And while bonds, we said earlier this year that bonds are terribly hated and everybody hates bonds, and really talk about negative sentiment, that was really in the bond market to a large degree. But here over the last few days, and this was interesting because the day before the CPI inflation print yesterday, bond yields have actually been moving back lower. Now they're back to the 20-day moving average as well. Still on, kind of an overbought signal here. So that suggests that we could see rates come down a bit more. And in fact, interest rates are slated to be a little bit lower this morning as well. But again, that's been kind of offsetting over the last couple of days. This decline in rates has been offsetting some of the risk in the equity side of portfolios because of that trade-off between stocks and bonds. And again, we're certainly not out of the woods just yet by any stretch of the imagination. There's certainly a lot of concerns here. And again, Mike and I will get into kind of the larger context of this. But as you can see here, TLT had a very nice bounce here over the last couple of days. And we're starting to actually see that money flow situation starting to improve here as well. So again, as we kind of see more money flows coming in, where we potentially see better bond prices, that'll help hedge some of the risk in portfolios. The one other side of this story this morning, of course, is Ethereum and Bitcoin. The cryptocurrencies are very interesting because these were touted as a hedge for inflation, a replacement for gold. You don't want to be long the dollar, because dollar's going to zero. You want to be long Bitcoin, and that, well, Bitcoin's been under a tremendous amount of pressure, currently trading around 26,000, down from 69,000 at its peak just last year. Huge decline in Bitcoin, but again, much like everything else, and again, there's a very high correlation now between Bitcoin and high beta stocks. Very oversold here as well. So again, we're just seeing kind of this selling pressure across all asset classes, and all this suggests that you're going to get a pretty good reflexive rally. The problem is when is it going to come? Is it going to come from here or from much lower levels before you get that rally? Unfortunately, we just don't know. But this is the point we've been making the last few days. This is where we typically make emotional mistakes, and we kind of start just, done, I'm out. I start kind of emotionally panic selling things, typically right at the bottom. And that's where we just, try to avoid, that type of emotional trade. I know it's painful right now. I know it just sucks at the moment. But give this market a little bit of room here, because again, you're likely to get a rally, and when you do, sell that rally, raise more cash, and you'll do a bit better job for yourself longer term as well. So again, no guarantees, of course. There's a lot of unknowns in the market. We're going to get into that this morning with Michael Leibowitz when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to ensure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Real Investment RealInvestmentAdvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. I'm Real Lance Roberts. Michael Leibowitz joining me as well to talk a little bit about everything. We've got a lot of stuff to get into this morning, starting with inflation. Yesterday's inflation number was kind of interesting because out of the 8 sectors that make up the CPI index, only 4 of them, about half of them, only 4 of them were actually up. Energy, surprisingly enough, was down by a decent percentage over the course of the last month. And, but what's still continuing to weigh on the inflation numbers, of course, is homeowners equivalent rent, which is a very big part on a percentage basis of that calculation. So inflation did come in hotter than it was expected yesterday. However, the month over month and year over year rates of change actually did decline. So one of the questions will be whether or not, going forward, if we continue to see those rates of change, continue to decline here on a month over month and a year over year basis. And the odds are very high that is indeed going to be the case, even if housing prices and rents stay about where they are. And if we just continue to print, say, a 0.3% increase, which is higher than the norm, over the rest of this year, inflation rates are going to fall into the 5% range by the end of the year. Again, as we said before, though, doesn't mean that things are getting any cheaper for you. That doesn't mean gas gets cheaper, although I did see gas this morning under $4 on the way to work. So I thought that was interesting.
Lucky you.
I know. That's what I get for living out in the sticks. By the way, I have an oil well right next door to my house, so I just drive up and attach myself.
Tap into that.
Exactly. I wish it only worked that way. But anyway, that's kind of the idea. And of course, I think, this, as I was saying a second ago, interest rates may be also giving us some clues here. Because over the last couple of days, we've seen a fairly decent drop in interest rates. Anyway, let's get into this. Michael Leibowitz joining me this morning, posting this morning, talking about Bill Dudley yesterday. You in our daily commentary that you can get on our website now at realinvestmentadvice.com. You put an interesting piece of commentary in from Bill Dudley, who has been railing against the Fed here lately on inflation.
Yeah, Bill Dudley was at the New York Fed for about 10 years, and he has been very outspoken about the Fed, thinking that they're doing things wrong, criticizing them. Earlier, before the Fed was doing anything, he thought the Fed should have been tightening policy much quicker. He saw inflation coming on. He was a proponent for the Fed to do something. The Fed didn't do it. Now he's getting on the Fed because it's too late. And the Fed, I guess, in his opinion, is still not even aggressive enough. And in his words, they're sugarcoating the economy, the jobs market, and inflation. And he said, basically, the Fed's really doing a disservice to the American people, but to themselves, because it's making their job harder.
Yeah, it is making their job harder, but again, the market's kind of doing the work for them. I understand his point that, he thinks that the Fed needs to hike rates faster to tighten monetary policy quicker, but if you take a look at financial condition indexes, they're as tight as they were at kind of other recessionary points in the cycle. And, the decline in the markets obviously weighing on sentiment, weighing on consumer sentiment. Consumer sentiment continues to drop here. The NFIB, National Federation of Independent Business, their outlook for the economy is basically one of the lowest levels in the history of the reporting of that index. So, despite the fact that the Fed really hasn't raised rates much on their end, which may come back to kind of bite them in the butt when they actually need to start lowering rates again, the market's been doing a lot of the work for them.
Here's the problem. The Fed can only control demand for the most part, the demand of goods and services. And what's partially driving inflation is demand. And in order to slow demand down, you need the unemployment rate to reverse and start going higher. Right now, it's basically at all-time lows. Almost every measure of employment's at all-time lows. And you need the economy to slow down. You need both of those to happen. And yes, the economy had a negative GDP number, but these numbers, economic data has been so volatile, it's hard to make sense of down, 1.4%, just as it was equally hard to make sense of plus 9% in the prior quarter.
Right.
You just have a ton of volatility. And yes, I think the economy is slowing. I think the jobs market is actually starting to turn, although it could be a little while before we see that show up in the data. But that's what it's going to take to bring inflation down and the supply side to be fully operational. And China's locking down everything again. And that's causing supply line problems. And I think a lot of our producers are not fully producing because they're really concerned about what's going to happen to demand. So we have this lingering inflation effect. But Lance, I think CPI was a very important number that the market overlooked. What was that, yesterday?
Right.
And the market was so keyed up on expectations on where they thought it would be and not the momentum.
Right.
Look, month over month inflation was 0.3%. The prior month was 1.2%. If you annualize 0.3%, that's about 3.6%. That's, I think the Fed would jump for joy if they knew that inflation is running at 3.6%.
Yeah.
That's much higher than the 10+% annualized rate that we had a month ago. So it seems, based on, we're seeing some normalizing of prices. Used car prices are down, right? Energy prices are where they are 3 months ago, but they're crude oil hasn't really popped above 110 a barrel.
Right.
It keeps bumping up against it and falling down. So the month over month price is not really changing, as you talked about earlier. And the prices of other things are moderating. So what we're getting to is that the inflation rate is slowing. It doesn't mean prices are coming down, but they're just not going up 8 to 10% on an annualized basis. They're slowing. That momentum is slowing. And I think that's the important part in that number. And inflation is it's impossible to calculate. There are so many things that go into inflation: geography, buying demand. I could make a list 10 pages long of what you need to calculate inflation, and it's different for everyone.
Right.
So the fact that it was 0.1% off tells me nothing. It's like the employment number. It's a survey of a really small number of people, and from that, everyone on Wall Street is glued to, was it over or under by 5,000 people or something crazy like that. So I think, look, just keep an eye on the momentum of inflation. It could have been under by 1/10, over by 1/10. I'm not sure that really matters. What matters is next month, do we see it stay low, 0.1, 0.2, 0.3%? And, the other thing we've talked about, Lance, is the math behind CPI. If you go back a year ago, CPI, that's when CPI took off, and it was starting to rise at 0.6, 0.8, 0.9% a month. Well, if you think about it, if a year ago it rose at 0.9 and it's rising at 0.3, as you add that plus 0.3, you take away that plus 0.9, and that brings the year over year rate down.
Right.
Call it whatever you want, but that's the math behind year-over-year inflation, and that's why it fell from 8.5 to 8.2.
Yep.
And that then the propensity will be for it to fall further, purely because of the math, assuming we don't start running at 0.9, 0.8, 0.7% monthly inflation.
Mm-hmm. Well, and again, one of the points you made, and I think this is a key point that a lot of people are overlooking is employment, and that's kind of a really big factor for the Fed. Again, the Fed's two primary mandates are price stability, i.e., inflation, and full employment. And one of the hammers that they have with monetary policy is impacting financial markets, because that has some other implications throughout the economy. And one of those is that, for the Fed, one thing they can do is control that psychology. And we're seeing them do this. And this is starting to weigh on employers. And we're already starting to see employers talking about, not hiring as fast. We're already starting to see wage gains trying to moderate here a bit. Because, again, one of the things that are contributing to inflation is rising wages. And so if he can control the employment side of the equation, suppress stock prices to the point that companies become concerned about outlooks, then all of a sudden, maybe they don't hire as much, they don't raise wages. That starts to also impact that inflation push in the economy. It also slows economic growth because people don't have a job and they have less money to spend. But that all kind of dovetails back into this trying the ability to try to lower that rate of inflation. Unfortunately, the trick, and this is the one thing they've never been able to quite figure out, is how to engineer that without causing a pretty decent recession. So, I don't know if they succeed this time with a soft landing. I'm not. I'll take the under on that bet. But
and going full circle, that's why Bill Dudley says they're sugarcoating it.
Yeah.
Because the Fed does not want to come out and say we need to raise the unemployment rate and we need a recession. That's what we need. If you want to cut inflation right back down, that's what we need. And the Fed will never say that. The president will fire Powell, as Trump tried to do, if he says something like that. And there's a lot of political pressure to sugarcoat it.
Right.
As
Well,
Bill Dudley used to say.
Yeah, and again, look, I appreciate Dudley's position, but again, the Fed is kind of as you stated, they're kind of in a tough box. Despite the fact they're supposed to be independent, they are very politically motivated, and we saw that back in 2018. And it's not going to surprise me to see more of that here. I mean, we've seen them talk about the Fed's now going to fight climate change. And, we need to do these other things that have nothing to do with monetary policy. But they've now gotten sucked into this whole kind of political environment, which is not great long term. I mean, that has other unintended consequences that, I think we'll see come to the surface. But even the U.S. Treasury, the Treasury Department itself, Janet Yellen, has gotten sucked into these other political debates on socialism and modern monetary theory that have nothing to do with her job as Secretary of the Treasury. Anyway, different conversation, different day. We'll come back. Let's talk about markets. Markets under a lot of pressure here. Bitcoin as well. We'll talk about where we are and potentially what happens next. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual lunch and learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife took my youngest daughter down to the pool store to buy a float. My daughter finds this one that's as giant as you can imagine. This float of a dragon. So it's got this big head on it, and it's got a tail coming out the back. And of course, it's the biggest float they have.
The Real Investment Show podcast.
Yesterday morning, my Ring doorbell goes off. Here's my wife chasing the dragon down the street.
At realinvestmentadvice.com.
Dragons are real.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The most important insurance policy you'll ever own is the one you'll have when you die. Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income and protect your real estate. Thursday, May 12th at noon. Register now for the truth about life insurance at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. It is, of course, Thursday as we get ready to wrap up this trading week. And, of course, just been another tough week in the books. Whatever the markets try to rally, they try to get something going out of the gate. Buyers come in and just immediately they're just trampled to death by sellers. And that's just kind of been the story this week. And that makes it very difficult. This is, kind of the point of where, as we've been talking about lately, even for Mike and myself, I mean, nobody's immune to emotions. And this is where you're really starting to try to fight those emotional pressures to make, emotionally driven decisions in your portfolio that may work out well in the short term, but not well in the long term, or, may be a terrible decision short term, but a good decision long term. I mean, you never know how these things are going to turn out. And this is why it's important to always try and focus on a little bit longer term goals. Try to, not get swept up in that emotional bias in the short term, because typically this is where investors, make the most mistakes, wind up selling low, wind up buying high, just all those types of, things that happen. And, we've seen some days over the last couple of weeks where the market's up 3% in a day. And it's like, okay, finally, here's that rally. And the next day you give it all back up again. So again, it has just been an incredibly tough market to trade and navigate this year. But again, this is kind of where we are at the moment. Markets are trying to figure out this whole dynamic between inflation, economic growth. If we take a look at a lot of, investor psychology and investor sentiment, we're at levels normally kind of associated with, short-term market bottoms, but yet the market just kind of seems to keep wanting to sell off here. And there's certainly a lot of great cases. Right now there's, the bearish sentiment is certainly ruling the roost for the first time in a few years. The bears are having their day. That's great. But we are starting to reverse some of that overvaluation. We are starting to reverse some of those, catalysts that guide us to this point. Again, we go back and look at the meme stocks as an example. Those have been absolutely decimated. Coinbase yesterday down almost 30% in a day after they reported their earnings. It's just we're seeing a lot of those types of companies really, really being impacted here. So the question becomes, kind of what happens next? I mean, is it all over? Is the bull market done forever? And that's typically the attitude that we start getting into, is that, well, this market's just going to go to zero, and the world's coming to an end. And it's interesting to me that over the last few months, it was all about the dollar going to zero. I can't tell you how many articles people sent me about the dollar going to zero, and yet the dollar continues. It's been actually one of the best investments this year just to be long the dollar. So, again, markets tend not to do the things you expect them to do always in the short term. Doesn't mean long term they don't turn out that way. Doesn't mean long term the dollar doesn't go to zero. I'm not saying that at all. I'm just saying, these kind of one-sided arguments tend not to work out very well, in the shorter term time frame. But anyway, having said that, let's talk about where we are in the markets right now, Mike. Markets are, as I said this morning in the open, kind of going through this. I mean, if you take a look at markets in terms of normal kind of statistical measures, deviations from daily and weekly moving averages, as an example, the markets are, 3 standard deviations below the 1-year moving average. And that's something that you only see near market bottoms. We the only other times we've seen it over the last 5 years has been at the bottom of the market in 2018 and the bottom of the market in 2020. Outside of that, you don't get this deviated from weekly moving averages. Your thoughts?
So there's a few big picture items that I'm constantly thinking about, or have been constantly thinking about, and we've been talking a lot about, Lance. Yeah. Are we in a bear market? Big question number one. Is this 2020 where we have a really sharp drop and within months you're gaining big chunks of that back? Or are we in more of a 2000, 2008? Circumstances were different in both, but are we in more of a prolonged bear market, or more of a traditional bear market that could see prices go decently lower from where we're at? And those are the answering that question is huge, and no one has that answer yet. But we keep our eyes on the Fed because the Fed is a big determinant of that. But we also keep it on a whole host of other factors, such as valuations, technicals. Now, let's just assume the worst case scenario, that we're in a bear market. We're in a 2000-like bear market. This looks a little more like 2000 and 2008, at least right now. Mm-hmm. Banks are not failing left and right. And, there are problems, but right now the financial sector appears to be okay. So we go to like that 2000 to 2003, called a 2.5, 3-year bear market. Well, within that bear market, there were significant rallies. There were 6 or 7 rallies of greater than 10%. So here we are, we're down about 18%. The market is showing that we're very oversold on just about any kind of measure. It most likely will bounce here. And it will be a pretty big bounce. Mm-hmm. Doesn't mean it's going to last for 3 weeks and just go up for 3 weeks. But we could see within a matter of days a couple hundred points, maybe even more in the S&P 500. Then we got other questions to ask. Okay, was that the reflexive bounce? Did that get all our technical indicators back to fair value, maybe even slightly overbought? And how do we adjust at that point? And that goes back to question number one. Right. Are we in a bear market, or are we back to kind of 2020-ish, where we got a severe drop that's going to, claw back, pretty quickly? And, one of the things that I think that we've done well at, we don't do well at everything certainly, but one thing we've done well at from day one, from January 1st, is we've increased our cash. I think we're sitting on roughly 30% cash right now, maybe even a little bit more. And I think this is equally important. We've shifted our allocations. Mm-hmm. So we have reduced our technology holdings, for instance. We own more energy than the indices own. We are overweighted in some of the more conservative, lower beta sectors. our fixed income portfolio, we get a lot of heat over, but we have about a third of what we should own based on what our benchmarks are telling us. So the key is, it's not just selling. Don't just sell and go away necessarily. You can reduce exposure, but you also have to think about what you're investing in. Energy stocks are up roughly 30% this year.
Right.
That's unbelievable. Some of the staples and conservative stocks are still up on the year. So there are places to hide. There are places that even if they go down by much less, that can reduce the volatility in your portfolio.
Well, and this is kind of also one of the problems that investors get into is that they go 100% in one direction, right? So they're all in, then they go all out, and the problem is always getting back in again, as we've talked about before. But to your point, I think one of the questions that is important to answer is are we in a bear market or not? And I think really what defines that differential, so the difference between 2020 versus 2000 and the dot-com crisis, one of the differences to 2020 is that in the midst of that decline, which turned out just to be a correction, we got down to long-term moving averages, which is kind of where we are now. So if we start looking at weekly, monthly moving averages, we're sitting on some very important long-term moving averages where we are right now. And the difference was at that point, the Fed came in with cutting rates to zero, and actually they were already at zero from the Fed. And then they came in with a massive amount of QE, right? We're going to do this $1.2 trillion a month in QE. And I think that's, where the difference lied to a large degree of what stopped that market from becoming a much deeper decline. And right now, to your point earlier, the Fed doesn't seem to be any rush here to come to bail out markets, which would suggest that at this point, any rally that we do get is a sellable rally to reduce risk, rebalance exposure, exactly what we have intentions of doing. We've been nibbling on some value stocks here lately, just adding a little bit of stuff that's really been beaten up. Of companies that we like that have good, strong fundamental balance sheets. And I think that's a key differential too, is the stocks that you own. Do you own stocks with good, strong fundamentals, or do you own stocks that don't make revenue? And that's going to also be a big difference into how your portfolio is performing this year. Danny and I were talking about this yesterday, is despite the fact that the S&P is only down 18%, the average portfolio is down 28%. And that's because a lot of people were chasing a lot of these innovation companies that don't have revenue, that don't really have strong balance sheets, and they've now gotten heavily penalized for owning those types of companies versus just owning, the stocks that make up the S&P 500 index for the most part. So, there's, to your point though, is that the risk that we're in a bear market is certainly there. And until those dynamics change, I think you've got to treat it as if we're in a bear market and use rallies to reduce risk, rebalance exposures, and make adjustments accordingly. So we'll come back and talk a little bit more about that. I also want to get into Bitcoin. Talked about that a little bit at the open this morning, but what happened to Bitcoin? The whole premise behind Bitcoin, where did it go? We'll talk about that with Mike Laser Eye Leibowitz right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the Insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So, flipping gears here from financial markets under pressure to cryptocurrencies, which are also under a lot of pressure here. It's very interesting, as I noted earlier in the show today, that, Mike and I, personally, we took a lot of heat here on the radio show a while back when we were talking about cryptocurrencies and, kind of undermining the case that, no, they're not a replacement for currencies, and they're not a replacement for a fiat currency because they're fiat themselves. In fact, Coinbase made a very interesting statement yesterday. Coinbase currently custodies $256 billion worth of assets, and they note in their Q4 filing that if the company goes bankrupt, holders of those crypto assets on Coinbase could lose their assets to creditors. And because it would become an asset of the company to meet debt obligations of the company to their creditors, which means that you may wake up one morning and the company files for bankruptcy and you have no cryptocurrency left. That doesn't happen with the U.S. dollar. So, this whole idea that, it's a fiat currency or it's not a fiat currency, it's a replacement for gold, it's a hedge against inflation, all these theses that were put out there about cryptocurrency itself have turned out to be false and wrong. And it's because that they, while they are certainly can be used as a currency, right? I can make an exchange for something. I can go and I can send Mike Bitcoin and he can send me a graphic caricature of an ape. In exchange for that Bitcoin, we can make a transaction. But if Mike wants to use that Bitcoin for anything, he's got to convert it back into U.S. dollars to go buy a car or whatever. So, ultimately at the end of the day, a currency is only valid if it is a medium of exchange. And it has not attained that yet. It's also a fiat currency because there's nothing backing it. And as Coinbase have just alerted their holders of Bitcoin and Ether, you may well find out one day that, you wake up and your money's just gone. And, the one thing about the U.S. dollar is that it has the full faith and credit of the U.S. government behind it. You may not like it because it's not backed by gold, but you're not going to wake up one morning and your dollar just be gone, like gone. Like you don't have it anymore, type gone. You know, and that's a very different environment. What Bitcoin has turned out to be, and as Mike and I had said early on, and we took a lot of heat for it, and now it's become true, is that it's basically it's an asset. It's a speculative asset that people can buy and sell, run up and down in price, and it actually has now attained a very high correlation to high growth, beta, momentum names, like we've seen in the stock market. So again, it turned out very much to be a retail kind of frenzy. And I'm not saying that it's over, it's dead, and it's never coming back. That's probably not the case. It's very likely we'll see Bitcoin and Ether have a very strong rally back at some point. But again, like the market, it's a function of beta, it's a function of volatility, and it's a function of risk on attitudes and appetites, and we just don't have that right now. But Mike, to the question, I thought one of the interesting things that has happened in the cryptocurrency world is what's going on with these stable coins, right, which, the whole premise of the stable coin is that it doesn't lose value. It's pegged to the dollar, and which is also interesting, but it's pegged to the dollar, and which has been going up. The U.S. dollar is up about 8.5% this year. Has been a very good investment. If you were just long the dollar, you've done very well this year as a hedge against the markets. But the stable coins, not so much. In fact, big news over the last couple of days is that one of the stable coins actually broke the buck, so to speak, and that's where they lost their peg to the dollar. In other words, the value of the currency fell below the dollar value of the peg, and investors are now getting back less than $1 on their investment. So, what's your view on this now, and kind of where are we?
So I think the stable coins are fascinating. And it's something I've kind of read up on over the last week or two and didn't really appreciate what stable coins are. Stable coins are essentially the money market funds for cryptocurrency. Mm-hmm. So in the stock market, if I go sell 100 shares of Apple at my Fidelity or Schwab account, that money, the proceeds, go to my money market account at Fidelity. Now let's say I want to sell 100 shares of Apple and I want the money to go to my bank. Mm-hmm. Well, it goes from selling Apple to my money market fund at Charles Schwab, from my money market fund at Charles Schwab to my bank, where it's also going to sit in a money market fund. So unless I take that money out as cash, it's going to sit in a money market fund.
Correct.
And I don't care, because that money market fund will always have a price of 1. Now, if you remember in 2008, a money market fund broke the buck. That means that it wasn't worth 1 anymore. It went down to 98 cents or 99 cents. The Fed went crazy, because that's trust. Once you start, that's really trust in the whole system. Mm-hmm. And when you start breaking the buck on money market funds, people are going to withdraw cash like you've never seen, and there isn't enough cash.
Right.
The cash doesn't exist for all the money that actually exists. That's a story for a different show.
It's called fractional reserve banking, and that is a whole other problem. I don't think you
want to hear this, especially if you're driving.
Exactly.
It's not safe. But so you go to cryptocurrencies, and there's two kinds of stable coins. Think of stable coins as the money market. So if you sell your Bitcoin, it goes into, in that case, something called Tether, which is a stable coin. And then you can have your custodian basically convert the Tether to US dollars, mm-hmm. Or to another currency, or back to Bitcoin, or whatever you want to do.
Right.
So there's two kinds of stable coins. One is algorithmic, and one is actually backed by something. Algorithmic is like an ETF, and it basically says that there are such incentives for the dealers or for people to keep the stable coin at about a price of 1 that'll never get away from 1. That's like ETFs. Mm-hmm. ETFs have a basket of 10 stocks. If the price of the ETF varies from the price of those 10 stocks, there's a dealer that's incented to buy those 10 stocks and deliver it in and sell it at the higher ETF price, or vice versa. And because of that, the very liquid ETFs always stay exactly at their, or very, very close to their net asset value. And that was true for the algorithmic stablecoins as well until the last week or so. And they've been collapsing. And while it's nice to think that dealers will come in and do their job and make the easy money, when we run into times of illiquidity, this is what happens. And the liquidity in general in stable coins is nothing like it is in some of the big name ETFs or in the money market funds or any of that type of stuff. There's another kind of stable coin that's backed. The Tether backs Bitcoin, I believe, and that is apparently backed by U.S. Treasury bonds and cash. That's a much firmer backing, assuming it's true. And whether it's true or not, I don't know. And there are rumors. It's kind of like the gold ETF. Is there really all that gold in the vault? Everyone likes to think so, but no, there are theories that the answer is no.
Right.
So think about it. If you own, there's this cryptocurrency called Luna, and it's backed by a stable coin called Terra. Well, Terra was trading at 50 cents, 60 cents, 30 cents on the dollar. All of a sudden, your Luna, regardless, even though its price was dropping like a rock, the value to convert it was also dropping like a rock. So people start selling Luna, in part because their whole money market system, the infrastructure is devastated. And that's what's going on in a lot of cryptocurrencies and stable coins now.
Well, and again, it's also just, again, it's, as we talked about before, it's also a lot of the high beta trades. A lot of it was on margin, and we're starting to see margin redemptions to some small degree right now. But, as prices continue to fall, more and more margin calls come, which require people to sell more and more assets. And so if I've got some money in Bitcoin and I'm getting margin calls in my stock trading account on Robinhood, I've got to start selling my Bitcoin to go cover my margin calls at Robinhood. And it's just a bad situation, particularly if I'm chasing a lot of those, high beta names that are dropping, 10, 20, 30%, like we saw yesterday with Coinbase. This is just kind of that part of the liquidation cycle that we're in. And it's, as I said earlier, when you're looking at the average account being down 28% for the year, that tells you that a lot of investors were really on the wrong side of the trade in this, for this market. And again, even 18% is a lot to be down in this market. But again, 28% is a very different story. But this is, but we kind of go back to the premise of this conversation and the whole premise behind, stable coins and Bitcoin and cryptocurrency. It was a great idea. The problem was that there was a flaw to the analysis, which was that it was going to be a replacement for fiat currencies. And the big difference, and this is the thing you and I pointed out long ago, was that you have a government backing the U.S. dollar. There's nothing backing a cryptocurrency. It's just the value of the people buying and selling it that drives the price. There's nothing behind it. And as Coinbase notes, if they go bankrupt, you lose your money. And that's certainly not helping Coinbase's price this morning, which is going to be under more pressure as people realize that the further that stock drops in price, the risk of bankruptcy continues to rise. So again, hey, Mike, thanks for joining me this morning. Be back tomorrow with Financial Fitness Friday with Danny Ratliff and Richard Rosso. Of course, our newsletter will be out this weekend, and we'll update you on the markets, where we are, and so much more. Stick around. 3 minutes on markets and money is coming up, and also get by our website, simplevisor.com. A lot of new stuff we've got coming out on our digital platform as well. So again, as we continue to migrate all of our research to that website, you'll have access to that as well. Simplevisor.com. Have a great day. See you back here tomorrow.
It's a rich man's world.